Medical Properties Trust, stock ticker MPW, saw a massive drop in its most recent trading day, and we can see over the past year it's down around 70.39%, and in the past 5 days alone, down over 28%, and it's now trading at around $3.55 per share. So in this video, we need to discuss what is going on with Medical Properties Trust, and of course, we'll also be looking at my valuation spreadsheet, which you can download on my Patreon page. Okay, so we have lots of news to discuss with Medical Properties Trust, but for a moment, let's go ahead and step back and look at how the real estate market has performed as a whole over the past year. We can see VNQ, which is Vanguard's Real Estate Investment Trust Index Fund, is up 5.42% over the past year. So it's not like real estate investment trusts have just been struggling over the past year. Overall, they've actually seen positive returns. So that makes it even worse when you look at MPW's massive underperformance over the past year. We can see the company currently has a starting dividend yield sitting extremely high at 16.9%. If we jump over to the dividend history tab for this company, we can see they did recently have a dividend cut going from 29 cents per share all the way down to 15 cents, something you obviously don't want to see. That was a decline of over 50%. And the reason they did this was to preserve cash and strengthen its balance sheet. Now, why did they need to preserve cash and strengthen its balance sheet? And that kind of goes back to why we saw the massive drop in share price over the past few days. Let's go ahead and dig into that. If we come to the Seeking Alpha article and scroll down, let's go ahead and look at this first paragraph. Medical Properties Trust stock plunged 31.3% in Friday late morning trading to the lowest level it's seen since 2009, as the REIT said it had taken steps to recover uncollected rents from troubled tenant Steward healthcare system. On Thursday evening, the hospital landlord said it had been granting a $60 million bridge loan to Steward, which is about $50 million behind in rent payments as it struggles with liquidity issues. Now let's stop right there for just a moment and think about how a real estate investment trust operates. On a very basic level, it's really not that complicated. Real estate investment trusts own property and the tenants pay the REIT rent. The real estate investment trust then takes the majority of those funds and pays it to its shareholders in the form of dividends. So by that logic, those dividend payments are really only as safe as the rent payments from the tenants are. This goes back to the classic saying that a REIT is only as good as the tenants in its portfolio. So to hear that Medical Properties Trust has one of their tenants having major problems to pay rent, that is obviously not a minor issue. Add in the fact that Steward is also one of the largest tenants in their portfolio, that just adds fuel to the fire. Now the problem with tenants is nothing new to Medical Properties Trust, and in fact, like we've already seen, they have been taking steps to try to preserve cash because of some of the problems with their tenants. For example, like we already saw, they already cut their dividend, and around a year ago, they actually sold all of their Australian assets as well. Now, despite all of this, it's still not enough to give investors confidence in this company. Throw in the fact that they currently have a short interest at over 25%, and you get a stock that is now down 70% over the past year. Now, one of the things I want to do is I want to jump into the financial statements. First, let's jump over to the income statement. If we scroll down, I want to look at the total interest expense. Now, there's typically two different ways that a REIT can grow at a rapid rate. They can either take out debt or they can issue new shares. And if we look at the total interest expense here, we can see it's rapidly been increasing over the past decade. If we scroll back up, let's go look at the balance sheet. And if we scroll down to the bottom of the balance sheet, one of the things we want to look for is total shares outstanding. And again, the total shares outstanding for this REIT have been rapidly increasing, something you don't usually want to see as a shareholder as it dilutes your shares, but this is pretty common for real estate investment trusts. But I do have to say, the rate that they have been issuing new shares is pretty dramatic, and it's a little bit higher than I'd even like to see it for a real estate investment trust. So as of right now, there's definitely no lack of problems with Medical Properties Trust. But let's go ahead and glance at the valuations. And again, like always, if you'd like to download the spreadsheet, then you can head over to my Patreon page at the link in the description. Okay, if we come over here and plug in MPW and hit enter, you can see all this data will automatically load in. 500-day change chart, obviously something very ugly, and the 20, 50, 200-day moving averages, pretty ugly as well. We already touched on the massive starting dividend yield sitting at 16.9%. Analysts have a target price of around 5.39%, institutional ownership around 76%, and a beta of 1.15, so you'll see a little more volatility with this company. Now, the first valuation we will look at is the AFFO multiples. This is essentially a way to see how the market is valuing companies that are similar in structure, so you can see our comparable companies here, and we can see their price to AFFO multiple. Now, the average price to AFFO multiple for these companies is sitting at 12.12. Now, MPW's current price to AFFO is sitting at 2.73. So when you apply the average P to FFO to Medical Properties Trust, you actually come to an intrinsic value of 15.77, way above the current trading price for Medical Properties Trust, but don't get too excited. We'll touch on why this is in just a little bit. If we jump over to the historical price to FFO model, we can see for the trailing 12 months, their price to FFO is way lower than it has been on average for the last 10 years, another indicator that it's undervalued, but again, don't get too excited yet. Lastly, let's go ahead and look at the dividend discount model. And again, we did recently see a dividend cut from this company. Now, even if we project 0% dividend growth for this company moving forward, with an 8.5% discount rate, we still come to an intrinsic value of $7.06 per share, quite a bit higher than that current trading price, almost double that current trading price. So when we jump over to the output tab, we can see two of the valuations we used came to an average intrinsic value of 11.41. Throw in the fact that with the historical price to FFO, we found it was historically undervalued. So what's the case? Why is this company apparently so undervalued? And the answer is actually rather simple. Many of the problems we're seeing with this company are forward-looking problems, meaning the result of them hasn't really set in yet. The company can somewhat cover up for a short period of time the fact that they have massive debt and massive interest payments, growing shares outstanding, and major problems with tenants, but sooner or later that's going to catch up with the company. And that's something investors are aware of. For a while there, it did look like MPW could be a good value play, but it looks like they've dug themselves in a hole that they're going to have a hard time getting out of. And as I was reading an article from my good friend Brad Thomas on Seeking Alpha the other day, I thought he made a great point. We need to be investing in companies that generate stable and predictable earnings. Investors are willing to pay a premium for predictability, and in the case of MPW, it's just really hard to know where they're going next. So on the surface level, while the valuation does look good, I really don't think this is a good opportunity. I do think in the big picture, it is possible they could turn things around and you could see a nice gain, but the potential reward is really not worth the risk, in my opinion. So like always, if you'd like to be able to join a community of dividend investors and get access to any of my spreadsheets like this one, then you can head over to my Patreon page at the link in the description. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.